This video is going to take a look at adjustments that might involve changes that are necessary to creditors. So creditors are the people that you owe money to, the business owes money to. Okay, so we'll get started. So a couple of things before we begin. Prices. So the difference between cost price, selling price, recommended retail selling price. So it's kind of important when to know this when you're looking at all the different types of adjustments. So cost price is how much it costs to make the product or how much it costs to buy from the supplier. Selling price is how much a business sells its products to their customers for, and recommended retail selling price is invoice received from a creditor showing an RRSP, means how much your supplier recommends you sell the products to your customers for, and invoice sent to your debtor showing an RRSP is how much you recommend your customer to sell the products to their customers for. We also need to know about VAT. So it's the obligation of the seller to collect the VAT and forward it on to the revenue commissioners. So if we sell goods on credit to a debtor, we credit the sales account, the VAT exclusive figure, so the amount exclusive of VAT. Then we put the VAT amount on the same side as the sales account, and then we put the VAT inclusive figure on the debit side of the debtor account. So say for example your VAT was 23%, your 100% would go in here, your 23% would go in here, and your 123% would go in there. If we purchase goods on credit from a creditor, so this is what we'd be looking at here, we would debit the purchase account, so 100%, the VAT exclusive figure. We would put the 23% VAT on the same side as the item it's attached to, in this case it's purchases, and then we would put 123% or the VAT inclusive figure on the credit side of the creditor account. So creditor adjustments, what we have seen in the exams so far. First one would be a mistake that the bookkeeper has made in their bank account. Second one, you could have goods in transit at the end of the year, so you've received an invoice from your creditor and no entries been made. Another one then, we could have a restocking charge, so our creditor is charging us a restocking charge when we sent goods back to them, but we haven't accounted for that yet. And then in 2017 we saw one where fixed assets were given to a creditor in place of paying them a debt, so instead of paying cash or check or whatever. So the bank adjustments, so we see the bank adjustments. Have a look at the bank adjustments video if you haven't seen it yet, but basically the bookkeeper's bank figure and the bank figure don't equal, and what has happened a lot of times with creditor is that the bookkeeper record a transaction to creditor incorrectly in the bank account, or they didn't enter it at all, and then in the creditor account the bookkeeper recorded transaction incorrectly in their creditor account or hasn't entered it at all. So we'll see some of them now in a moment. Next we have goods in transit at the end of the year on the 31st the 12th. So goods are in transit on the 31st the 12th. You've either sold goods and they're en route to your debtor, invoice sent, or what we'll be looking at now, purchase goods and they are en route to you from your creditor, so the invoice is being received. So for example, no record has been made in the books for goods in transit on the 31st the 12th. The invoice for these goods was received showing the recommended retail selling price of €23,000, which is cost plus 25%. Okay, so we adjust the closing stock in the trading profit and loss and balance sheet as follows. So we increase the closing stock by the cost of the goods bought, which is 18,400, which is 23,000 recommended retail selling price, divided by 125 and multiplied by 100. We'll increase the purchases by 18,400 in the trading profit and loss, and we will increase the creditors by 18,400 in the balance sheet. So this is how it would look there in the accounts. So another one then, restocking charge. So not as common as the other two, but whenever goods are returned, the seller has the right to charge a restocking charge on the return if it has cost them like time or money to restock the goods. So it might cost you wages for somebody to restock the goods or whatever it might be. So a restocking charge from creditor, what we do is If we haven't catered for the restocking charge, we'll add the restocking charge to purchases and the creditor account. So it's never happened in an exam before, but we could see a business charging their debtor a restocking charge. So how would we deal with that? A restocking charge to debtor, we would add the restocking charge to sales and to the debtor figure. The last one then is where a business would have traded fixed assets to a creditor instead of paying them cash or check or whatever. So if they sold fixed assets such as office equipment, okay, we would minus the cost of the office equipment from the office equipment account, or we would minus the accumulated depreciation from the accumulated depreciation account. We would minus the debt to the debtors that they've written off. We might have received a discount, so we'll just put a question mark there. If you're asked to calculate depreciation, then it would go there, and then we'd add the depreciation for the year to the office equipment depreciation there. So that's it. So we'll get started and have a look at some past exam creditors adjustments. So there's about 12 years to look at. So 2021, question 1A, we had two different things happening in the bank adjustment. So note 7.2, so a check for 18,700 issued to a supplier had been entered in the books, the cash book and ledger as 17,800. And then note 7.3, a check for 4,800 issued to a supplier had been returned. This had not been entered in the books. Okay, so we get started. So you're looking at the trial balance, you see what the bookkeeper's bank figure, and you're looking at AIB's bank statement, and they said 29.2. Now this is going to be a bit lost here if you haven't looked at the bank adjustment stuff yet, but I'm just picking out the bits that relate to the creditor. If you want to see this completed, go to the bank adjustment video. So a check for 18.7 issued to a supplier had been entered in the books as 17.8. So the bookkeeper here made a mistake. She put in the wrong figure. So she should have recorded the check to the supplier as crediting the bank account 18.7 and debiting the creditor 18.7. But what she did by mistake was she credited the bank 17.8 and debited the creditor 17.8. So to fix that, we'll have to credit the bank account and debit the creditor, which means minusing from the creditor and adding to this overdraft here. So it's the bookkeeper's bank figure that there was a mistake in, so that's why we're putting it under the bookkeeper's bank figure. And then you've got the creditor minus 900. So that's how you do the first one. The second one then, a check for 4,800 issued to a supplier had been returned. This had not been entered in the books. Okay, so it hadn't been entered in the bookkeeper's books. So the check had just been returned to the business. So the business still owes the supplier that, but they have to record that the check has come back to them. So it'll be money coming into the bank. So when they sent the check to the supplier, the bookkeeper credited the bank. So now we debit the bank account, which means that would reduce the bank overdraft figure by the 4.8. So now we have to record that we still owe the creditor 4.8, that we owe it to them again. So with creditor here, we'll add 4.8 there. And that is that. So how would the creditor look then? So this is just the finished adjustment altogether, but just to put in the creditor, we would minus 900 and plus 4,800 to the trial balance figure. And that is that one done. In 2020, we have the same thing again in the bank, and we also have another one up here at the top, the goods in transit, that affect the creditor figure as well. So note 2, no record had been made in the books for goods in transit on the 31st of the 12th, 2019. The invoice for these goods was received showing a recommended retail selling price of 24,500, which is cost plus 25%. Note 7.2. So a check for 16,500 issued to a supplier had been entered in the books, the cash book and ledger as 15,600. And then note 7.3. A check for 2,500 issued to a supplier had been returned. This had not been entered in the books. Okay, so we'll do the goods in transit first. So goods in transit, you've already got your closing stock from note number 1. But when we've goods in transit, the recommended retail selling price is 24.5, which is cost plus 125. If we divide that figure by 125 and multiply it by 100, we get 19,600 is the cost, how much it costs for you to buy that from your creditor. So we're adding that to closing stock, we'll add it to purchases, and we'll add it to the creditor figure. And that's that adjustment done. Next then, we'll move on to adjustment number 7, where we had 2 items there affecting the creditor. So here, our bank figures don't equal. This bank figure here is the bookkeeper's bank figure, 48,800 overdraft, and then this one, the AIB's bank statement, 32,000 overdraft. So looking at note 2 then, we're just going straight to the ones that affect the creditor. So a cheque for 16.5 that the bookkeeper issued to a supplier was entered into their books as 15.6. So the bookkeeper made this mistake. No difference, no effect on the AIB's bank statement. So this is what should have happened. They should have entered 16.5 on the credit side of the bank and then 16.5 on the debit side of creditor to show they no longer owe the creditor that 16.5. But they put in 15.6 by mistake. And to fix it then, we'll credit the bank 900 and we'll debit the creditor 900. So nothing is going to impact the AIB there, but the bank overdraft figure will increase by 900 because it's 900 more coming out of the bank. And then the creditor, we will minus 900 from the creditor. Then note 3, a cheque for 2,500 issued to a supplier had been returned. This had not been entered in the books. So 2,500 issued to a supplier had been returned. That means that the cheque came back to the business, but it means that we now owe the creditor that amount again. So when that cheque came back into the business, all right, it debited the bank account. So when we had sent it previously, we credited the bank account. So now it's going to debit the bank account. That's going to reduce the bank overdraft by 2.5. And it's going to increase the creditors by 2.5 because we need to show that we owe this creditor this amount again. And that's that. Okay, so this is how, this is what your bank adjustment looks like when it's completely finished, but we just put in the creditor amount, all right? So the creditor amount then, we just have to minus 900 and we have to plus 2,500 there. So this is your goods in transit one, and then that's the bank adding to that. Right, so 2017, there was 2 adjustments that affected the creditor. So we have a creditor who was owed 7,600 accepted office equipment with a book value of 6,500 in full settlement of the debt. The office equipment had cost €11,000. No entry was made in the books in respect of this transaction. Provide for depreciation on office equipment held on the 31st of the 12th, 2016 at the rate of 20% of cost. And then note 9, no record has been made in the books for goods in transit on the 31st of the 12th, 2016. The invoice for these goods has been received showing the recommended retail selling price of 16,000, which is cost plus 25%. Okay, so there's a lot going on here. So this adjustment here, first time we've kind of seen anything like that in sole trader final account, or even indeed any final account, but we've seen it in tabular statements a lot. So look, let's have a look and see what we do here. So your office equipment, we got this figure from these figures from the trial balance, and we got the creditor's figure from the trial balance. So the creditor was owed 7.6 and they took equipment in full settlement, so we no longer owe the 7.6. The equipment had cost 11, so we'll take the cost away from there. And the depreciation on that equipment over the years was 4,500 because it had a book value of 6.5 and it had cost 11. So that's 4,500 accumulated depreciation. Now, the creditor accepted something worth 6.5 for a debt of 7.6. So therefore it means that the business got a discount of 1,100. So that's the debt to the creditor minus what they give them in return. So 1,100 discount. Then it tells us provide for depreciation on office equipment held at the end of the year at the rate of 20% of cost. So office equipment held is 25 minus 11, 14,000 by 20% is 2,800, which we will add up here to the accumulated depreciation bracket, and that's that done there. Now, next then we say that no record has been made in the books for goods in transit on the 31st of the 12th, 2016. The invoice for these goods had been received showing the recommended retail selling price of 16,000, which is cost plus 25%. So we have our closing stock here and in our current assets. So where did I get this 12,800 from? Well, the invoice was received showing the recommended retail selling price. So 16,000 is the recommended retail selling price, but that is cost plus 25%. So 16,000 into your calculators, divided by 125, multiplied by 100 is 12,800. That is what it costs to buy them from the creditor. And then we add that to our purchases figure and we'll add it to our creditors figure. So that is the recording of that invoice. Right, 2014. So 2 adjustments in this year as well. So we have goods in transit and then we have a restocking charge. So number 1, stock at 31st of the 12th, 2013 at cost was €80,000. No record has been made for goods in transit on the 31st of the 12th, 2013. The invoice for these goods have been received showing the recommended retail selling price of 4,800, which is cost plus 20%. Note 4 then, goods with a retail selling price of €15,000 were returned to a supplier. The selling price was cost plus 20%. The supplier issued a credit note showing a restocking charge of 10% of cost price. No entry has been made in respect of the restocking charge. Okay, so let's get started then. So we've got closing stock here. All right, and so we need to add the cost of the goods that were in transit. How do I get that €4,000 here? Well, the invoice that I received from the creditor showed a recommended retail selling price of 4,800, which is cost plus 20%. So if you put 4,800 into your calculator, divide it by 120, multiply it by 100, you're going to get €4,000 there. We're also going to add that to the purchases figure, so the trial balance figure, whatever that was, and the creditors figure, so whatever that was there as well. So 110,000 from the trial balance plus 4,000. So that is the 2014 question done. Okay, so now we have this is 2013 then, sorry, so 2013. So 2013, the figure for bank in the trial balance has been taken from the firm's bank account. However, a bank statement dated 31st of 12th, 2012 has arrived showing an overdraft of 39,720. A comparison of the bank account and the bank statement has revealed the following discrepancies. A cheque for 680 issued to a supplier had been entered in the books, cash book and ledger as 860. Okay, so only one adjustment here in the 2013 question. So again, the bookkeeper's bank figure and the bank figure are different, okay, and we need to reconcile them. Only one of these items relates to our creditor, so that's all we're going to look at now. So a cheque for 680 issued to a supplier had been entered in the books, cash book and ledger as €860. So this is what the bookkeeper should have done. They should have said 680 came out of the bank and our debt to the creditor reduced by 680. But what they did by mistake was they said it was 860 and 860. So to fix that then, we will put 180 on the debit side of bank and 180 on the credit side of the creditor. And that is that. So it affects the bookkeeper's bank account figure. So that's money coming into the bank, which is going to reduce the overdraft, and it increases the debt to the creditor. So it goes into your accounts like this. This is how it affects the creditor, whatever the trial balance figure is, plus the 180. So that's just everything else that should happen there as well. Okay, 2012 then. So 2012, another bank adjustment. So a check for 640 issued to a supplier had been entered in the books, the cash book and ledger as 460. So again, same type of mistake. The bookkeeper's bank figure and the bank's bank figure do not equal. One adjustment that relates to the creditor here. A check for 640 issued to a supplier. So 640 comes out of the bank and then the debt to the creditor should reduce by 640. But what the bookkeeper did by mistake was they put 460 on the credit side of bank and 460 on the debit side of creditor. So how do we fix that then? We'll have to add another 180 to the credit side of the bank and add 180 to the debit side of creditor. So it only will affect the bookkeeper's bank figure, not the AIB's bank figure, because the bookkeeper made the mistake. So this credit bank entry here will increase the overdraft, and then the creditor, we minus 180 there. And that is how it's going to look in the creditor account. And this is just everything that happened in that adjustment. Okay, 2010 then, we just have a restocking charge. So restocking charge, so note 5, goods with a retail selling price of 8,400 were returned to a supplier. The selling price was cost plus 20%. The supplier issued a credit note showing a restocking charge of 10% of the cost price. No entry has been made in respect of this restocking charge. Okay, so retail selling price of 8,400, selling price was cost plus 20. The supplier issued a credit note showing restocking charge of 10% of cost price. No entry in respect of the restocking charge. So we're going to add 700 to purchases and add it to creditors. How do I get 700? So the goods had a retail selling price of 8,400. We divide that by 120, okay, and we multiply it by 100 and we get 7,000 euro there. Then we multiply that by 10 and that is our restocking charge. So that is the answer to that 2010 creditor one. Okay, in 2008 we had a goods in transit and a restocking charge. So let's get started with the goods in transit. So number 1, stock at 31st of the 12th 2007 at cost was 75,000 euro. No record has been made in the books for goods in transit on the 31st of the 12th 2007. The invoice for these goods had been received showing the recommended retail selling price of 6,000 euro, which is cost plus 25%. And then note 4, goods with a retail selling price of 10,000 euro were returned to a supplier. The selling price was cost plus 25%. The supplier issued a credit note showing a restocking charge of 10% of cost price. No entry has been made in respect of the restocking charge. Okay, so here we go. So we've got closing stock here, 75,000, and we add 4,800. How did I get that 4,800? That is my recommended retail selling price of 6,000 divided by 125 and multiplied by 100 to get the cost price, so 4,800 there. We'll also throw my closing stock over in the current assets, and then we need to add 4,800 to our purchases figure and add it to our creditors figure as well, as we have purchased goods on credit from the creditor. So that's the first part. The second part, number 4, says goods with a retail selling price of 10,000 euro were returned to a supplier. The selling price was cost plus 25%. The supplier issued a credit note showing a restocking charge of 10% of cost price. No entry has been made in respect of the restocking charge. Okay, so the goods were 10,000 euro, were returned to supplier. Selling price was cost plus 25%, so 10,000 is 125%. Multiply that by 100. The selling price 10,000, the cost price 8,000. So the supplier issued a credit note showing a restocking charge 10% of cost price, which is 800 euro. So that's how I did it again. 10,000 divided by 125 multiplied by 100 is 8,000 by 10% is 800. So we add that to purchases and we also add it to creditors down here as well. And that is that one done. Now, in 2007, we have a bank adjustment. In 2006, we have a goods in transit adjustment. 2004, we have another bank, and 2002, we have another bank. So I'm going to let you guys practice what you've learned here so far and see, can you get the answer to what do you need to do to the creditors, okay? And again, if you're not sure about the bank adjustments, try and have a look back at the bank video and it should make a lot more sense. Okay, so we'll get started then with the 2007. So just the creditors part here now. Okay, so that was 2007. Hopefully you got the creditors part right there. The next part then is goods in transit in the 2006 question. Okay, now you have 2004, another bank adjustment. And then we have 2002, another one. Okay, so that's all the creditor adjustments going back as far as 2002. So as you've seen there, we've got mistakes in the bank account. We've got goods in transit at the end of the year. We have a restocking charge to a creditor, and we have where we traded a fixed asset to a creditor instead of paying them cash, and we got a wee discount off them as well. So that is all of the creditors adjustments completed there.